Stare at that date on your terminal and let the gravity hit you. This isn't a standard session. It is Wednesday, December 31st, 2025, and we are inside the final 36 hours before the silver game is rigged differently forever. In just 36 hours, the sun hits January 2nd, the party ends, and the Red Dragon's export ban becomes hard law. But here's the thing the herd misses. The event hasn't started on paper, but it effectively detonated in reality. Smart money doesn't wait for news. They front-run it, and right now that front run has officially snapped the market's spine. For the past 48 hours, we have warned you about a bifurcation, a hard divorce between paper spot and physical truth. Today, that split isn't just theory. It has ripped into a canyon so deep that true price discovery has totally failed. As I speak to you right now, there is no single global price for real money. There are multiple realities coexisting at once, and most stackers are watching the wrong one. The digits on your banking app, the ticker on the cable news that isn't a signal anymore. It is a complete and total phantom now. We are watching the breakdown of a unified market into tiers, each showing a different level of stress and reality. One tier is fueled by panic, another by real physical scarcity, and the last by pure paper delusions. This is exactly what hits when a rig built on leverage slams into a hard deadline and physical limits. The rules of finance can be twisted for decades, but the laws of supply and demand always come to collect their pound of flesh in the end. This isn't about technicals, candles, or short-term gambling anymore. This is about holding it versus owning an IOU. It is about who holds the metal when borders shut and the licenses go dark. Over the next few chapters, I will walk you through exactly how this break happened, why the ARB is dead, why delivery demand went vertical, and why the spot price you see is no longer the price that counts. The countdown isn't to a future event. The countdown is to the real awakening. If this intel helps you see what the normies still can't, type the number 1 in the comments and ensure you are subscribed so you do not miss the next big breakdown. If you want me to cut the feed, type number 2. To understand just how deep this crack runs, we must dismantle the myth of a single silver price. What exists now is a 3-tier market, and each tier tells a radically different story about fear, scarcity, and control. If you are only watching one of them, you are blind to the real signal now. Tier 1 is the panic price. This is the rate paid in Shanghai, the industrial engine of the globe, as the final trading session of the year wrapped silver in Shanghai was trading at the equivalent of $84 and change. This isn't speculative fiat. This isn't hedge funds chasing green candles. This is the price paid by factories, refiners, and strategic whales who actually drain the metal. They aren't guessing. They are reacting. They see the export ban clock ticking, and they are paying whatever it takes to secure the stack before the big vault door slams shut hard. Tier 2 is the physical cost outside the blast zone. In hubs like the Middle East and real physical souks where metal swaps hand silver is trading just under $80. This market is tense but rational. It isn't in full panic mode yet, but it is demanding a massive premium. It is quietly proving that physical silver is already worth way more than the paper lie. This tier is crucial because it proves the issue isn't just China. The shortage is fully global. Then we hit Tier 3, the most dangerous one of all, the zombie spot. This is the paper price in New York drifting aimlessly in the low 70s. This figure looks calm. It looks steady. And that is exactly why it is so fake. The spread between Shanghai and New York is now over $12 a gap, so massive it shouldn't exist in any honest and free global market. In a sound system, that spread would be erased instantly by the arbitrage bots. Traders would buy low and sell high until rates converged. But they aren't doing that because they can't. The metal cannot flow. The deadline is too tight. The bridge between paper and physical is totally torched. What you see on the screen isn't a price. It is a delayed echo from a market that has lost all control now. A $12 spread on a global asset is not just odd, it is a declaration of total failure. Silver is fungible. An ounce in New York is supposed to be interchangeable with an ounce in Shanghai. The whole structure of modern commodity markets is built on that faith. When that faith finally breaks, everything built on top of it starts to really crumble. In a sane world, this gap would trigger a total feeding frenzy. Banks, hedge funds, and trading houses exist for one reason: to exploit inefficiencies like this. If arbitrage were alive, they'd be buying every available ounce in New York and shipping it east, locking in risk-free gains measured in billions. The fact that this isn't happening tells you everything you need to know. Arbitrage is dead because the flow is truly dead. The pros know the clock better than anyone. They understand logistics, customs shipping schedules, and regulatory choke points. They know that even if they bought silver in New York today, there is no physical way to land that metal in China before the export licenses go live. January 2nd is a brick wall. No amount of leverage can punch through it. So instead of closing the gap, the market is watching it rip apart in real time now. This is how New York became an island. It is a paper island surrounded by a sea of real physical shortage. Contracts are still trading, algorithms are still firing, but nobody wants to take delivery on the other side. When you see the spot price sitting calmly in the low 70s, understand what it represents. It is essentially the cost of a promise that most players no longer trust. The real economy has already voted. Factories, energy producers, and strategic buyers are not dealing with spreadsheets. They are grabbing atoms. And while the physical world reprices upward, the paper market lags behind, frozen by its own rigged structure. This is why the spread is not closing. It is why it is accelerating. The market is no longer unified enough to heal itself. Price is only half the story. The other half is volume, and this is where the situation turns from scary to explosive, while the paper price drifted. Something far more vital happened beneath the surface. Delivery demand didn't just rise, it went absolutely vertical. Just one day ago, the physical delivery stats were almost laughable. Out of billions of paper ounces traded, barely a handful of contracts actually stood for real delivery. It was the perfect symbol of a casino market, all leverage and no intent. But today, that illusion collapsed in a single session. Nearly 2,000 contracts suddenly demanded physical metal. That is over 9 million ounces of silver requested in a single day. This was not a gradual increase. It was a coordinated run. Thousands of large players looked at the calendar, saw the same deadline approaching, and made the same decision at the same time. They stopped rolling contracts forward. They stopped trusting paper bets. They effectively smashed the delivery button. This is the moment when a paper market panics. Delivery is the one thing it cannot fake. When a system designed for speculation is forced to act like a warehouse, it snaps. A 26-fold spike in delivery demand isn't normal market behavior. It is a raid on the vault. It is the system trying to correct years of suppression in 48 hours flat. Imagine being the bankster on the other side of that trade. You sold a contract assuming it would be rolled as it always was. Suddenly, the buyer wants bars, not cash. You now have to source millions of ounces in a market where physical supply is vanishing and premiums are skyrocketing. This is exactly how liquidity vanishes overnight. This delivery shock is the pressure point. It drains inventories, exposes leverage, and forces banks to hunt for cash. It is not noise. It is the sound of a market realizing that the clock has totally run out. When physical delivery surges at this scale, the damage doesn't stay confined to the commodity pit. It ripples straight into the banking system. This is where the story leaves the charts and enters balance sheets, and the evidence here is far more deeply disturbing. To settle those delivery demands, banks have only two options. They either hand over metal from their own vaults, which are already very thin, or they rush into the open market to buy silver at any cost required. Both options are catastrophic. Draining vaults leaves them naked heading into the export ban. Buying in the open market forces them to pay premiums far above the paper price they sold at, locking in immediate losses on every single ounce. This is how a liquidity spiral starts. Losses consume cash. Cash shortages force emergency borrowing, and that is exactly what we saw unfold over the last 48 hours. While the herd was focused on holiday headlines, the Federal Reserve quietly injected billions into the banking system through emergency repo operations. Not once, but actually twice. Nearly $6 billion of overnight liquidity was pumped into the system in 2 days. That isn't routine. That is triage. Banks don't beg for cash on New Year's Eve unless something is deeply and terribly wrong. This money wasn't used to expand lending or stimulate growth. It was burned to keep the plumbing from freezing while delivery obligations were being met. This is the hidden cost of spot price suppression. Every fiat dollar injected is a subsidy to a broken rig paying the spread between fantasy prices and physical reality. It buys time, not solutions. And time is the one thing the system no longer has. The liquidity injection is not a sign of strength. It is proof that the pressure has reached the core. While Western banks were desperately scrambling for dollars, the real crisis was unfolding thousands of miles away quietly and relentlessly inside the Shanghai vaults. This is where the story stops being about sentiment and starts becoming about math, and math has no mercy. In just 48 hours, more than 80 metric tons of silver were drained from the Shanghai exchange. Let that number sit with you for a moment. This is not a spike in normal industrial demand. Under healthy market conditions, Shanghai typically sees withdrawals of 2, maybe 3 tons per day. What we see now is over 40 tons per day. That is not consumption. That is liquidation of inventory at emergency speed. This behavior only appears when participants believe future access will be cut off. Buyers are no longer optimizing price. They are optimizing survival. They are pulling metal not because it is cheap, but because it may soon be unavailable at any price. That distinction matters. Once a market crosses from price sensitivity to availability panic, the whole structure changes. At the current bleed rate, several percent of the total registered inventory is disappearing every single day. Inventories do not glide toward zero. They snap. When stockpiles fall below critical psychological thresholds, buyers do not slow down. They double their orders. Fear feeds on itself. The curve goes exponential. And here's the key. This drain is irreversible. Every ounce removed from Shanghai is an ounce that will never be used to rebalance global prices. It cannot be shipped back west. It cannot be rehypothecated. It is locked behind policy strategy and national interest. This is why the Shanghai price is not reacting to New York. It is ignoring it. You can inject billions to save a bank. You can suspend rules to save a market, but you cannot conjure 80 tons of silver out of thin air. The depletion math alone tells us this rig cannot stabilize. It must break, and it will break where reality lives. What begins in vaults never stays in vaults. Scarcity always migrates downstream, and now it has reached the factory floor. This is the moment when theory turns into boardroom reality, and it is the most dangerous phase of the collapse. For decades, global manufacturing has been built on a single assumption: just-in-time delivery. Companies minimized inventory, maximized efficiency, and trusted that raw materials would always be available when needed. That assumption just collapsed. When supply chains fracture, just-in-time becomes not in time, and the consequences are instant. The world's largest industrial consumers of silver are no longer behaving like price takers. They are behaving like survivalists. We are seeing emergency procurement orders that would have been unthinkable weeks ago. Corporations that typically hold days or weeks of inventory are now trying to secure months of supply in advance. This is not speculation. This is business continuity. For these companies, the price of silver is almost irrelevant. Silver represents a tiny fraction of the cost of an electronic device, a solar panel, or a battery system. But without it, production stops entirely. Paying a premium is survivable. A shutdown is not. That is why bids are rising without any hesitation. This industrial panic creates a self-reinforcing loop. Every large buyer who hoards supply removes metal from the open market, tightening availability for the next buyer. That buyer then responds by hoarding even more aggressively. The result is a cascading demand shock that no paper derivatives can absorb. At this stage, the market is no longer being driven by traders or speculators. It is being driven by engineers, procurement officers, and executives staring at production schedules. When factories need metal, paper contracts become meaningless. They will outbid each other in the shadows, off exchange, away from screens, and those prices will never show up on a chart. This is how a commodity leaves the financial system and re-enters the real economy. And once that happens, paper loses its power completely. While industrial giants were quietly securing supply behind closed doors, The signal became impossible to ignore on Main Street. This is where the paper price finally loses all credibility because reality starts demanding cash, not paper contracts. If silver were truly trading in the low 70s, you would be able to buy it at that price. Try it. Walk into a local coin shop or open a major online dealer's website and attempt to purchase physical silver at the so-called spot price. You can't. What you will see instead are premiums that have exploded into the double digits. Government-minted coins, which normally carry modest premiums, are now priced more than $10 above spot. Even generic rounds, the lowest tier of physical silver, are commanding premiums that would have been considered impossible in a stable market. Dealers are not being greedy, they are being honest. They know replacement costs are rising faster than screens update. This is the street price revolt. It is the physical market openly rejecting the number printed on financial terminals. Dealers understand a simple truth: if they sell inventory today at paper prices, they may not be able to replace it tomorrow at any price. So they price in the future shortage. They price in risk. They price in the reality. Supply chains behind the dealers are freezing. Wholesalers are pulling inventory. Mints are falling behind. Delivery timelines are stretching from days to weeks, and those delays are a warning signal. When a dealer says 6 weeks, it usually means the metal is not there. It means the system is totally gridlocked. This is the final confirmation. When factories, vaults, and storefronts all converge on the same higher price, the spot price becomes irrelevant. It turns into a historical artifact, a number that exists only on a screen detached from the act of buying and selling real physical metal. Now we stop looking backward and start looking forward, because what matters most is not what just happened, but what happens next. We are inside the most dangerous 36 hours the silver market has ever faced, and the sequence from here is now disturbingly clear. Phase 1 is the last window. As markets approach the holiday close, liquidity thins and desperation rises. This is the final opportunity for paper shorts to adjust positions before the rules change. You may see violent price swings, sharp drops meant to shake confidence, or sudden spikes as some players capitulate. None of it changes the outcome. At this stage, price volatility is noise. Possession is the only signal. Once the closing bell rings, we enter Phase 2, the void. Screens go dark, markets close, but stress does not pause. This is when emergency meetings happen. Risk managers run numbers they already know the answer to. Delivery obligations collide with empty inventories. Deals are struck quietly off-market at prices that will never be published. This is when premiums quietly explode in the dark. Then comes Phase 3, the reopening. When markets open with export restrictions active and arbitrage mathematically impossible, the paper system will try to reprice instantly. Gaps will form, algorithms will chase reality, but price discovery will be chaotic because supply is no longer elastic. Some sellers will simply refuse to offer real metal at all. This is also when defaults begin to surface. Force majeure notices cash settlements delayed deliveries. Not because of fraud, but because the system was built on assumptions that no longer hold. This is how credibility evaporates in a single, brutal trading session. The countdown is no longer theoretical. It is live and operational. This is where we slow down, step back, and extract the lessons that matter, because moments like this are rare and unforgiving. The silver market is not just repricing a metal. It is repricing trust structure and assumptions that have gone fully unchallenged for decades. The first lesson is simple: paper markets work until they don't. Leverage can suppress prices, smooth volatility, and create the illusion of abundance, but it cannot manufacture physical supply. When a real-world constraint appears, paper collapses inward. What we are watching is not a rally. It is a transfer from paper promises to possession. The second lesson is about timing and psychology. By the time headlines confirm a crisis, the opportunity has already passed. The smart money moves during disbelief, not consensus. That is why inventory drains, delivery spikes, and premiums matter more than charts. They reveal intent, not loose narrative. The third lesson is strategic. Silver is no longer just an investment asset, it is a strategic input. Governments, industries, and corporations are treating it that way because energy transition, electronics, and infrastructure depend on it. Assets that are essential and finite do not behave like ordinary commodities. They reprice violently and permanently when global supply chains fracture. So what is the rational response? Stay grounded. Avoid panic. Understand that volatility is a symptom, not a signal of failure. Focus on what you can control: education, risk management, and alignment with reality rather than screens. Do not confuse temporary price swings with real long-term value. We are facing a global monetary reset. The paper contracts will fail. The narratives will shift. When they do, the herd will ask how silver spiked so fast. The truth is, it didn't. It happened quietly, ounce by ounce, until the COMEX finally broke. If this helped you see the real money picture, make sure you like, subscribe, and share with anyone who still trusts the rigged paper spot price. Leave a comment below and let me know how you are stacking for the crash. Keep stacking, wait, stay prepped, and I will see you on the other side of the great wealth transfer.